Two things decide what you get out of a stock: what the business earns over the years you hold it, and what you pay to get in. Almost everything else is noise. Before any tool, any screen, any opinion, here are two charts that show exactly that. This is Costco over 10 years. The smooth line is what the business earned per share. $5.36 in financial year 2016. $18.24 in 2025. 3.5 times more. The jagged line is the share price. It wandered, it stalled, it dropped. And over 10 years it went where the earnings went. Now Nike, over the same stretch. Revenue grew from $34 billion to $46 billion. That is a bigger business, selling more shoes. But earnings per share went the other way, from $2.56 down to $2.10. And the price ran up to $177 in 2021, then handed all of it back. Today it sits about a fifth below where it started, which is roughly where the earnings went. One went up, one went down. The same rule explains both, and notice that Nike's revenue was growing the whole time. The market did not weigh the revenue. It weighed the profit. So the job is not predicting the market. The job is picking the business and picking your price. Buffett put it best, quoting his own teacher. In the short run, the market is a voting machine, and the vote requires only money, not intelligence. In the long run, it is a weighing machine, which gives you a method, and Terry Smith of Fundsmith wrote the shortest version of it anyone has managed. Buy good companies. Don't overpay. Do nothing. 3 steps. The rest of this video is what each one actually means, and the traps inside each one. Step 1. Buy good companies. Start with what you are actually buying, because almost every mistake in investing traces back to forgetting it. Walter Schloss ran money for nearly 50 years and put it in one line. A share represents a part of a business. It is not just a piece of paper. So when you buy a share, you are buying a claim on the cash that business will produce from today until it stops existing. That is the entire asset. Everything else, the ticker, the chart, the headline, is a description of what other people currently think that claim is worth. A good business is not a vibe, and it is not a brand you like. It comes down to 5 things you can observe in the accounts. We will take them one at a time and name the trap that sits inside each one. 1. Growth that is real. Revenue growing is not the same as the business getting better. You saw it already. Nike sold $12 billion more and earned less doing it. The question is never just is it growing. It is it growing without giving away the margin to get there? 2. Margins that hold. A margin tells you how much of each dollar of sales the company keeps. What matters is not the level so much as the stability. A margin that survives a bad year is evidence of pricing power. A margin that collapses the moment costs rise tells you the customer, not the company, is in charge. 3. Returns above the cost of capital. This is the one most people skip, and it is the most important. A business takes in money and reinvests it. If it earns more on that money than the money costs, growth creates value. If it earns less, then every dollar it reinvests destroys a little value, and growing faster just destroys it faster. 4. Profit that becomes cash. Profit is an opinion formed under accounting rules. Cash is a fact. When a company reports rising profit year after year but the cash never shows up, something is being counted early, or an asset is quietly swelling. You do not need to know which. You just need to notice the gap. 5. A balance sheet that survives a bad year. Debt is not a problem in a good year, which is exactly why people stop checking. The test is whether the profit still covers the interest when sales fall, because the businesses that get destroyed in a downturn are almost never the ones with weak products. They are the ones with a payment due. 5 checks, and every one of them is about the business rather than the market. Munger's instruction on this was blunt. Be a business analyst, not a market, macroeconomic, or security analyst. One warning before we move on. Every one of those 5 is relative. Here is the middle company in each sector of our universe, counting only those with at least $100 million of sales and how much profit each keeps from every dollar. In consumer staples, the supermarkets and household brands, the middle company keeps about 4 cents. In financial services it keeps about 17. Neither of those is good or bad. 4 cents is ordinary in one of those businesses, and would be alarming in the other. So a number on its own tells you almost nothing. You have to read it against the industry the company actually competes in. And that is a genuinely separate step. Step 2. Don't overpay. Go back to Costco, because we left something out. The earnings went up 3.5 times. The share price went up almost 6 times. So where did the rest of it come from? Not from the business. It came from the market agreeing to pay more for each dollar the business earns. In 2016, you paid about $30 for every dollar of annual earnings. Today, it is about 52. Same company, same checkout queues, and a much bigger price tag on the profit. That matters because only one of those two engines is durable. A business can keep earning more for decades. A multiple cannot keep doubling forever. And when it stops or reverses, you can be completely right about the company and still get a poor result, because you paid for perfection and merely got excellence. So what is a business actually worth? The honest answer is one sentence long. It is worth the cash it will hand its owners over its life, adjusted for the fact that $1 in 10 years is worth less than $1 today. That is it. Some models compute that directly. The rest, the ratios and the rules of thumb, are shortcuts that try to approximate it without doing the arithmetic. But that is the thing they are all approximating. Ratios like the price-to-earnings multiple are a shortcut to that idea, and they are useful, but be clear about what a shortcut hides. Two companies on the same multiple can be worth wildly different amounts if one of them grows and the other does not, or if one turns its profit into cash and the other does not. Cheap and undervalued are not synonyms. Plenty of things are cheap for a reason. Howard Marks makes the point that quality does not rescue you from price. At bottom, the riskiest thing is overpaying for an asset, regardless of its quality. Which sits right next to the line everybody quotes, and half of us misread. It is far better to buy a wonderful company at a fair price, than a fair company at a wonderful price. Read it again. It does not say price stops mattering once the company is good enough. It says a fair price, and it is doing real work in that sentence. Which brings you to the single most useful idea in this entire field. Margin of safety. Your estimate of what a business is worth is going to be wrong, because it depends on things nobody knows. So you do not act on the estimate. You act on the gap between the estimate and the price. Graham was precise about this. The margin of safety is always dependent on the price paid. It is large at one price, small at a higher one, and non-existent at a higher one still. Engineers build the bridge for £30,000 and then drive 10,000 across it. Same discipline. Step 3, and this is the one nobody makes videos about. Do nothing. Look at that Costco line one more time, but this time only the price. To have been there for the whole decade, you had to sit through this. And this. And this. Every one of those dips was a stretch of months where the sensible sounding thing to do was get out. The business was compounding the entire time. This is what Buffett is actually getting at. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. It is not a slogan about loyalty. It is a filter. If the reason you are buying would be invalidated by 6 bad months, then the reason you are buying is not the business. Doing nothing is also a decision, and it is a harder one than it sounds, because everything around you is built to make you act. Activity feels like diligence. Most of the time it is just cost and tax with extra steps. So here's the whole thing in 3 steps. 1. Buy good companies, and now you know what good means. Growth that is real, margins that hold, returns above the cost of capital, profit that turns into cash, and a balance sheet that survives a bad year. 2. Don't overpay, because the price you pay is the one part of the outcome you control on the day you buy. 3. Do nothing for long enough that the business, and not the mood of the market, is what decides your result. And here is the part that usually goes unsaid. None of this makes you right. Numbers describe what a business has already done, and what informed people currently expect. They cannot see a management team losing its nerve, or a competitor 2 years from launching something better. They narrow the field, and they stop you making the obvious mistakes. They do not remove the judgment, and anyone selling you a number that removes the judgment is selling you something. Running those checks by hand takes an evening per company, which is why we built Stockoscope. It pulls 10 years of accounts and breaks those 5 checks into 10 measurable pillars, scoring each one. It ranks the company against its actual industry, runs the valuation models with every assumption visible so you can change them, and shows you what analysts and insiders are doing. It does the arithmetic. You keep the judgment. Next in this series we take step 1 on its own, and show you those 5 checks in a couple of minutes instead of an evening. After that, what a business is worth, what the people closer to it expect, where to find candidates in the first place, and finally the whole method run on one real company from start to finish. This is general information about how to analyze a business. It is not investment advice, and Costco and Nike appeared here as illustrations of a method, not as suggestions. Do your own research.